If you think America's debt crisis will be solved by somebody sitting down and paying it off, honestly, you still think like a school child. That is not how empires handle debt. That is not how governments handle debt. And that is certainly not how central banks handle debt when the pile has become too large to retire cleanly without pain. The debt does not usually get paid off. It gets diluted, it gets stretched, it gets hidden inside growth, it gets washed through inflation, it gets turned into a problem for savers first and a gift for asset owners later. That is the machine. And if you understand that machine, what is happening at the Federal Reserve this year stops looking like a boring personnel change and starts looking like something much more important. A handoff, a reset in policy tone, a possible return to one of the oldest tricks governments know when the math stops working. I want you to hold one line in your head all the way through this story. America is not trying to pay off its debt. America is trying to outgrow it and devalue it at the same time. That is the line. Everything else hangs off that. When people hear that a new Fed chair may be coming in and that rates could fall, most of them think only one thought: good, cheaper mortgages, easier borrowing, higher stocks, maybe a little relief. That is how the public hears it. I hear something else. I hear the sound of a debt dilution machine being prepared. And debt. Dilution machines do not run on fairness. They run on two fuels: low rates and inflation that stays just high enough to quietly punish the people holding cash while rewarding the people holding assets. That is how the state gets a little less poor and the average saver gets a little more confused. This is not new. That is what matters. People think history only matters when it repeats perfectly. It does not. It matters because governments almost always reach for the same few weapons when debt becomes politically unpayable. I have seen this too many times in too many different forms to romanticize it. The names change, the officials change, the jargon changes, but the structure remains the same. When debt becomes too large relative to the economy carrying it, a government has only a few honest choices and none of them are attractive. It can default, it can slash spending brutally, it can raise taxes hard enough to create political revolt, or it can cheat slowly. Governments prefer the slow cheat. They prefer inflation. They prefer real returns below zero. They prefer getting richer by making savers poorer in ways savers do not fully understand until the damage is already done. That is the machine I want to explain to you. And if I were explaining it over a dinner table instead of into a camera, I would begin with one question. What is debt relative to? Because debt by itself is not the full story. A man with $1 million of debt and a $50 million. Dollar business is not the same as a man with $1 million of debt. And no income context matters for a country. That context is the economy itself. Debt relative to GDP. Debt relative to the productive machine underneath it. Think of GDP as the collateral. Think of debt as the claim against it. When the claim starts getting too large relative to the productive base beneath it, the lenders get nervous, the cost of borrowing matters more, and the policy choices get uglier. That is where America is. Now the debt is enormous, the interest bill is growing fast, and the ugly truth is that interest expense itself is becoming one of the fastest rising claims on taxpayer money that should bother any honest person, because every dollar spent servicing old debt is a dollar not spent on future growth, future resilience, future productivity, or even the illusion that your taxes are buying you something new. It is simply feeding yesterday. That is why this issue matters so much. Not because the number looks dramatic on screen, because debt service becomes a drag on everything once it grows large enough. And the public almost always notices too late. They notice only after the state has already chosen who will absorb the burden. Spoiler. It is usually not the people closest to asset ownership. Now, to understand what may be coming, we need to understand how America handled a similar burden before. After the Great Depression and World War II, the United States emerged with a debt problem large enough to matter. The debt to GDP ratio had become uncomfortably high. The government did not march out and nobly pay the debt off like a disciplined household. It used a far more elegant and ruthless method, financial repression. That phrase sounds technical enough to be harmless. It is not harmless. It is one of the most efficient systems ever invented for transferring wealth from prudent savers to a deeply indebted state. If I were simplifying it for a child, I would say financial repression means this. The government borrows cheaply, inflation stays higher than the return you earn on safe money. Time does the dirty work. That is the whole trick. The state does not need to pay the debt back in stronger money. It simply pays it back in weaker money while the economy grows in nominal terms faster than the debt appears to. That is how the ratio improves, not through honesty, through dilution. So how did they do it back then? They kept interest rates artificially low. That part is crucial. Not low in some moral or natural sense, low relative to inflation. If inflation is 5%, 6%, 7%, and the saver earns 1% or 2%, the saver is losing in real terms every single year. The statement might show a bigger number. That is not the same as actual preservation of purchasing power. This is one of the oldest confidence tricks in monetary policy. Give the saver a nominal gain and a real loss. He feels prudent. The government gets relief. That is why I keep saying that the public is not usually robbed by visible force. It is robbed by arithmetic wrapped in respectable language. The second part of financial repression is even more important. It is not enough for rates to be low. The government must also make sure there is enough demand for its debt at those low rates. Back then, that happened through rules and structures that made it very difficult for banks, pension funds, and institutions to avoid holding government paper. They were not always marched at gunpoint into treasuries. But the system was designed so that choosing anything else became less attractive, less convenient, less acceptable, or more costly. That is how the machine works. The state creates an environment where large pools of capital help fund the state cheaply. Meanwhile, inflation does its quiet work in the background. Now, if you are the saver in that environment, you lose. That is the point. The government becomes richer because the real burden of its debt is shrinking. You become poorer because your money is compounding more slowly than the cost of life. Those are not side effects. That is the intended design. Now, fast forward to today. The debt problem is larger than it was in that old era. That is what should make you sit up. Back then, the debt to GDP ratio was frightening enough to trigger policy distortion. Today, the ratio is worse. And that means the temptation to reach for the same toolkit is stronger, not weaker. This is where the incoming Fed shift matters, because leadership matters most when the machine is already under strain. A central bank chair does not create the debt problem. He decides which pain gets prioritized. That is a very different thing. And from what this source material is pointing toward, the next phase is likely to prioritize protecting the system from debt. Service stress, even if that means savers keep getting punished in real terms. That is the policy handoff I think most people are underestimating. Now let me name the 4 mechanisms I see in this story, because once you name the mechanisms, the whole thing stops feeling abstract. The first mechanism is the rate compression engine. This is the most obvious one. If the government has too much debt and too much of that debt rolls over in shorter maturities, then lower interest rates are not just about housing or stock market mood. They directly reduce the pain of servicing the national debt. That is not a theory, it is math. And math has no ideology. If you have locked in 30-year debt at low rates, you can survive a while. If your debt structure behaves more like an adjustable rate mortgage, then every move in rates becomes much more dangerous. That is where America is vulnerable. Now, the debt stack is not sitting there peacefully with the same long-dated comfort it once had. More of it has to be refinanced more often. That means lower rates are not just desirable. They are tempting in the way painkillers are tempting when the pain has become persistent. That is why the state wants lower rates so badly. Not because lower rates are morally superior, because lower rates make a bad debt structure more survivable. That is the rate compression engine. If a new Fed chair is more willing to cut than the old one, the whole machine gets immediate breathing room. Debt service pressure eases. Risk assets cheer. Borrowing looks less punitive, politicians smile. The public thinks help has arrived. But the relief is not free, it never is. Which brings me to the second mechanism, the saver transfer. This is the part the public hates least because it understands it least. If rates fall below inflation, then every person sitting in cash, CDs, or low-yield safe accounts is effectively lending stability to the system at a real loss. He is not just missing upside, he is financing the debt problem with his purchasing power. That is how I want you to think about it. Not as bad luck. As transfer, when inflation is 3% and safe yields are 2%, you are losing. When inflation is 4% and safe yields are 2.75%, you are losing. You might be losing elegantly, you might be losing quietly, you might be losing in a way your bank statement flatters. You are still losing. And that loss does not vanish. It goes somewhere. Some of it goes into easing the state's burden. Some of it goes into making asset owners richer because hard assets and productive assets tend to reprice faster than wages or cash balances. That is why inflation always feels like a class accelerator. It is not just a price problem, it is an ownership problem. People who own assets complain about inflation and then often benefit from it. People who hold cash suffer it directly, that is the saver transfer. And if this next regime does in fact push rates lower while tolerating inflation that stays above those rates, then the transfer becomes one of the defining features of the next few years. Now let us go to the third mechanism, the Treasury vacuum. This one matters because it is where the policy story becomes more complicated than the public realizes. If the Fed cuts rates while also shrinking its balance sheet, that means it is trying to remove money from one part of the system while easing another part. That sounds elegant on paper. It sounds like a way to enjoy lower rates without reigniting inflation. But somebody still has to buy the Treasury debt. That is always the issue. There is no central bank magic trick that removes the need for actual demand. If the Fed stops being a major buyer and becomes a seller or less supportive holder, then private buyers, institutions, pensions, banks, foreigners, someone must absorb the paper. If they do, fine. If they do not, yields rise. And once yields rise, the whole debt service problem gets worse again. That is the tension. This is why I do not believe any debt solution that relies on optimism about natural demand without asking who exactly will provide it, at what price, and under what regulatory incentives. History already gave us an answer. When the government needed captive demand badly enough, it made sure institutions had strong reasons to hold government debt, not by saying please, by shaping the rules. That is the part I think smart investors should watch very carefully. Because if private demand proves weaker than policymakers hope, history suggests the system will not simply shrug and accept higher rates. It will look for ways to steer more capital toward treasuries, maybe through regulation, maybe through incentives, maybe through subtle institutional pressure, maybe through changes that most ordinary savers never notice until afterward. But this is not theoretical. The rhyme already exists. That is the Treasury vacuum. The state needs the debt to be funded. If natural buyers are insufficient at the preferred yield, the system starts manufacturing preference. Now we come to the fourth mechanism, the AI alibi. This is perhaps the most politically convenient piece of the whole story, because every era needs a justification for why this time the old inflation trade-off will somehow hurt less. Today, that justification is productivity through artificial intelligence. I am not mocking the productivity potential of AI. Real productivity gains matter. They can lower costs, they can improve margins, they can reshape industries. But I am extremely wary whenever policymakers start using a genuine long-term technological trend as a near-term excuse for why monetary easing can be more aggressive than the arithmetic would normally permit. That is what I hear in this story. The argument goes like this. We can cut rates, we can shrink the balance sheet, we can manage the debt problem more softly, and AI will help hold inflation down because businesses will become more efficient, maybe. But I have spent too long around markets to confuse a plausible support factor with a guaranteed policy shield. AI may reduce some costs. It does not repeal the laws of debt math. It does not automatically create private treasury demand at the right price. It does not guarantee inflation behaves politely while rates are compressed. It does not prevent the saver transfer from happening. It does not stop assets from becoming the primary beneficiaries of monetary softness. That is why I call it the AI alibi. Not because it is fake, because it may be true enough to defend the policy without being true enough to remove the pain. That distinction matters enormously. Now, let me tie the four mechanisms together. The rate compression engine lowers debt, service pain. The saver transfer quietly taxes caution. The Treasury vacuum creates a need for real or manufactured demand. The AI alibi provides the story that lets policymakers tell themselves inflation can be contained while the system is eased. Put those together and what do you get? You get a possible new phase of financial repression, not the old one in identical costume. A modern version, faster, messier, more market-driven on the surface, but with the same basic objective underneath. Make the debt burden more manageable without ever confronting the public with the full explicit cost. That is the strategy. And once you see that, you stop asking the wrong question. The wrong question is, will the government pay off the debt? The right question is, who will absorb the cost of making the debt feel smaller? That question gets you to the truth much faster. And the answer, again, is not mysterious. Savers, cash holders, fixed income holders earning below inflation. Anyone whose financial life depends on nominal stability while the state is quietly pursuing real dilution. Those are the people most exposed, which means the winners, as they have often been, are the people who own productive or scarce assets. Stocks at the right valuations, real estate in the right conditions, gold in the right regime, maybe even other hard assets or alternative stores of value depending on the cycle. But the principle is older than all of the wrappers. Own something the state cannot quietly devalue at will. That is the principle. If I were building a defense against this regime, that is where I would begin. Not with panic, not with all, in behavior with ownership. This is what so many ordinary people still fail to understand. Inflation is not just a rising prices story. It is an ownership sorting mechanism. The saver without assets gets poorer. The owner with assets gets richer, unevenly perhaps, and with volatility, yes, but richer in the long sweep because the unit of account is being weakened. That is why people say inflation makes the rich richer. It is not because inflation is morally designed for them. It is because they own the things that get repriced while everyone else is still counting cash. That is why I keep returning to the same sentence. You cannot solve a debt crisis like this without causing pain. You can only choose who feels it first. That is the real function of policy here, not eliminating pain, allocating it. And the likely allocation, if this path unfolds, is familiar. Debt gets easier for the government. Cash gets weaker for the saver. Assets get bid up over time. The public gets told this is necessary, modern, and maybe even growth positive. The people who understand the machine position ahead of it. The people who do not spend years wondering why their salaries and savings never quite catch up. Now, I want to be fair. This does not mean every risk asset goes up in a straight line. It does not mean markets cannot crash inside the process. It does not mean there will be no recessions, no panics, no drawdowns, no false starts. History shows the opposite. Even inside long periods where debt was diluted and nominal asset prices rose over time, there were nasty corrections. There were scary recessions. There were moments when people thought the whole strategy had failed. That is why I never tell anyone to worship one asset or one narrative. The point is not to become dogmatic. The point is to stop being naive. If the regime favors ownership over hoarding cash, then you need ownership. If the regime punishes real returns on savings, then you must understand you are being taxed, even if the statement does not call it tax. If the regime is trying to shrink a debt burden through dilution rather than through discipline, then you should expect the value of cash to matter less and the value of scarce or productive assets to matter more. That is the intelligent conclusion. Now let me bring this down to household level, because that is where all macro stories become real. If you keep all your money in the bank because that feels responsible, you may be walking straight into the saver transfer. If you wait for perfect certainty before buying productive assets, you may spend years financing the state's relief with your own lost purchasing power. If you understand what is happening and gradually turn part of your paycheck into ownership, then when the repression comes, you at least stand on the side of the balance sheet that can benefit from asset repricing rather than only absorb the currency damage. That is why financial education matters so much here. Not because it lets you predict the exact meeting date or quote the exact percentage point of the next cut, because it teaches you how the machine works. And if you understand the machine, you stop taking everything personally. You stop asking why the saver gets punished. You understand that punishing the saver is the mechanism. You stop asking why assets keep recovering over long spans despite constant crisis. You understand that dilution is part of the answer. You stop asking whether the debt will ever really be paid. You understand that the debt is far more likely to be softened, stretched, and devalued than ever to be retired cleanly. That is what maturity sounds like in a debt-heavy age. Now let me say the hardest thing plainly. A lot of good, hard-working, moral people will do exactly the wrong thing in a regime like this. They will save diligently, they will avoid risk completely, they will think cash is prudence, they will think the absence of volatility is the same thing as safety. And then they will wake up a decade later and discover that their discipline was used against them. That is brutal, but it is common, and the only cure is to stop confusing calm with protection. Protection in a regime like the one we may be entering comes from ownership, optionality, and a realistic understanding of how debt burdens actually get managed. So if I had to summarize the whole thing for you in one final way, I would say this. The new Fed chair may not arrive with a magic wand. He may arrive with a plan that looks like relief but functions like dilution rates, lower debt easier, cash weaker. Assets stronger, AI used as the hopeful explanation for why it can all be managed cleanly. That is the outline. And whether that exact plan succeeds perfectly or not is not even the most important question. The most important question is whether you understand the direction of travel. Because once you understand the direction, your financial behavior changes. You stop worshiping cash. You stop treating debt math like somebody else's problem. You start watching the relationship between rates and inflation much more carefully. You start seeing asset ownership not as optional ambition, but as defensive necessity. And most of all, you stop believing that a government staring at $39 trillion of debt is going to choose the path of maximum honesty. It almost never does. History does not promise exact repetition, but it rhymes with frightening regularity. And this rhyme, to my ear, sounds a lot like financial repression preparing for another performance. That is why I would rather be positioned before the machine becomes obvious than apologize to myself afterward for having trusted the old definition of safety. That is how I would think about it. That is how I would prepare. And if I were you, that is where I would begin.